So welcome to the latest MoneyWise UK podcast. This is I would like to say, a show where we try to cut through the noise and we look to explore ideas, strategies, and also talk to people who are shaping the future of investing and financial planning. I'm your host, George, and today I'm joined by Kunal Desai, who's a co-fund manager of the Emerging Markets Active Engagement Strategy at GIB Asset Management. So we'll be exploring the navigation from political risk to active engagement on the ground in emerging markets. We'll dive into why emerging markets matter and how GIB's approach may offer something truly differentiated in this crowded space. So like always, I like to start with nice, easy, quick-fire, personal warm-up questions. So welcome, and let's start with something really easy. He says, who inspired you in your career or life more broadly?
You say that's an easy question, but that's probably one of the hardest questions to answer. And I guess, I think that the most obvious way in which one can think about it is one's family and one's parents, who are very instrumental. But I think that's something which is probably quite common amongst all your guests. I would say that the individual really which piqued my interest in investing was actually a family friend who was going through selling his pharmacy businesses. And the reason I say that was when I was a student at school and increasingly at university, my initial passion was about businesses and how to create businesses. But watching this family friend go through a process of looking to sell his pharmacies, to work through the puzzle of what valuation meant, I thought was something that increased my fondness for investing, because it wasn't just about how one builds businesses, but it's the price at which investors are willing to pay for such assets. And that interchange for me was very important in determining that actually there's something more than just about building and growing businesses. It's also through the prism of what valuation means. And that really set me on my journey towards reading and trying to understand what investing could mean for me.
Now, falls quite nicely onto the second one, which was, and actually this probably is really hard actually, is there a book that's had a lasting impact on your thinking or approach?
I think, certainly from a non-fiction perspective, when I first started my career at Neptune Investment Management, there was a huge amount of push towards reading and trying to develop one's own investment process. And Michael Mauboussin was an author at the time working, I think, at Credit Suisse. And he wrote very powerfully about how one should create frameworks for investing. And one of his seminal books, I think, is Expectations Investing, in which he talks about how everyone is a value investor, whether you're a value investor looking for businesses which are priced at very low multiples, or whether you're a value investor also looking at businesses which have pretty lofty market valuations. And really it's through the prism of understanding what's implied in a valuation of any business today, and where there can be revisions in terms of driving a higher expectation of the future cash flows that a company can generate. And when I started investing, initially I was working on companies in India. And obviously the market there is priced at a rich premium to the rest of the market. So a lot of investors used to write India off as being too expensive to invest. But really using Michael Maubossin's frameworks of expectations investing, one can make the case that actually these businesses are cheap relative to the expectations you have in terms of their compounding power and how those cash flows can grow. So I'd say from a non-fiction perspective, that was very instrumental in terms of thinking about how a framework and understanding what true value could mean. Just very quickly, from a fiction perspective, Atlas Shrugged by Ayn Rand was a book that I read, which again, probably from an early age, created a pretty lasting impression of what it meant to think about value creation. So in this book, it's really about focusing on value creation through aspects which one can control, thinking about seeking businesses with leaders who can really articulate a vision which is really shaped by their own struggle and their own capability, rather than focusing on handouts or ways in which subsidies or financial engineering which can make companies grow. So it was much more of a story, but it really created an understanding of what it was for business leaders to create value, which again, marrying it with expectations investing, created a really nice way of thinking about how my approach to investing began to develop.
And you talk about, obviously you just talked about how talk about the friend and family friend selling their pharmacy business. And do you think if you weren't in fund management, what would you be doing today?
I think everyone has ambitions of being a sports star in one form or the other, and that was certainly my passion when I was much younger. I think kind of obviously there was elements which meant that wasn't possible. I think, if it wasn't for investing, which I do believe is the most interesting career and kind of type of work one can do, but if I wasn't to do that, I think, linking to what I just said about Atlas Shrugged, it would be about trying to be an operator myself. So trying to set up a business which really lent on some of the skill sets which I believed I have, but also in an area which I have a deep passion and interest for. And I think one of the most interesting aspects of that book was really, the three protagonists in that book really talk about trying to find one's individual kind of capability and then champion that and drive entrepreneurship through the capabilities that you have personally, but also with the team around you. A number of my friends actually have gone into the startup ecosystem and have elements of struggle, but then also elements of deep fulfillment as they're able to scale these types of businesses. And being around such kind of passion and energy is something that I really do, or I would really kind of lean towards. That said, I think investing is something which kind of keeps me incredibly happy and purposeful, because you're essentially meeting these businesses and these entrepreneurs who've scaled their companies with the added challenge of working out what the puzzle of valuation means. And that's really why I think it combines quite neatly.
And I'm not sure if Neptune was your first company that you worked for. I came across Neptune many years ago, so
Yeah.
I'm aware of them. But can you perhaps just give a quick overview of your kind of background and how you found your way to where you are today?
Yeah, sure. So I studied economics and management at university, and really I came out of that not knowing what I wanted to do. I think at that time in 2008-9, a lot of my peers were going into consultancy, a lot of my peers were going into banking, and that was really about working through what makes companies great and creating an added way in which you could, help shape that through some consultancy projects or working alongside those businesses. I actually took a year out after university and went to India, where I worked there for kind of 6 or 7 months. I worked actually at the IPL, the Indian Premier League, which is a growing cricket franchise, which at the time was something quite small. And there I was really able to see kind of the vibrancy of Indian entrepreneurship, Indian business creation, and really where the journey of that market and country was growing was something that was deeply appealing and attractive to me. So when I returned back to the UK, I essentially wrote or went down to the back of the FT, and there they list the 150 odd funds which exist in the UK, and pretty much cold called the majority of them. And Neptune was one fund house which responded and said, that they would be interested to talk to me. And I started there as initially an analyst working on the emerging markets product, but then really focusing on India as an area which I wanted to create an expertise in and create a growing passion towards. So I ran the India fund there for kind of 6 or so years. And after that period, I decided to move to join Mobius Capital Partners, which was an emerging market boutique that was based in London. It was there really where I came across really my true calling, which was beyond India, looking at emerging markets. And secondly, and probably more importantly, what we believe true active management to be. And I think later on we can talk a little bit about what that meant. So Mobius, we created and grew the boutique. And in 2020, a number of my colleagues and myself, we decided to spin out towards GIB Asset Management, where we continue essentially that process and the way of investing today. So my journey really started from firstly working in an individual market of interest, which was India, and then looking to broaden out across all emerging markets. But really that belief and that interest in investing was something that started at university through meeting people, through some of those background stories, and crucially, the amount that you get to read, particularly at the early parts of your career.
Thank you. I thought what would be quite nice before, obviously we will talk about your strategy and the edge you have, but I think it's worth talking about emerging markets and understanding of what that is. And I mean, I was just talking earlier that I've just come back from a couple of weeks in Cape Verde, and you could
Yeah.
really see that as a proper emerging market where, well, basically they don't really have anything other than wind, solar, and tourism. And I guess, if we start with the basics, why? I guess we use this term emerging markets, and yet some of those economies are now, the largest in the world, or
Yeah.
maybe the US wouldn't like to see that, or close to the largest in the world. So why do we use this term emerging markets, do you think?
Yeah. So it's an interesting question, because when you compare some pockets of emerging markets, Pakistan, for example, which is very low on a kind of a per capita income basis, versus Korea and Taiwan, which is very high on a per capita income basis. They're very, very different, and yet they're under this same classification of being emerging. I think the first point is, from an investing perspective, it isn't just about income-based KPIs or characteristics, but really it also reflects capital market accessibility, regulatory clarity, and other per capita thresholds, which means that's why Korea and Taiwan are also included under this banner of being emerging markets with other lower income markets that you see around the world. So I think the first point is that it's a very broad set. Each individual emerging market continues and will continue to dance to its own beat. They're affected by different headwinds and tailwinds. Some are commodity importers, some are commodity exporters. Some are really driven by demographics, driving their potential of growth through labor force and productivity gains, whilst others are really shaped by the demographic advantage that other suppliers and export markets for them have to drive their own internal growth. So it's a very varied asset class. It's really a function of income thresholds, but also how we as investors can access these markets through that accessibility from capital markets, for example. But I think what they do have consistently is an enormous GDP share. So when you think about emerging markets in 2000, the share of global GDP was about 25%, and that's now doubled to about 50% in 2025, and would expect that to move to about 60% over the next 5 to 7 years. So the contribution in terms of global GDP is accelerating, and when you think about its contribution of incremental growth, that is even more attractive. So when we think about the emerging market members of the G20, they drove about 2/3 of global GDP expansion in the last couple of years. So despite this GDP advantage and this growing contribution to global growth, what's interesting about emerging markets is it remains a very underallocated asset class. So despite this size of being 60% of global GDP and being a driver, 2/3, 66% of incremental GDP growth, they only represent between 6 to 8% of most global benchmarks. And that really creates an opportunity for long-term investors to capture this global growth within an asset class which remains underowned. And that's why it remains, for us, a really important part of investors' total investor allocations.
And I guess kind of following on from that, is there other lines between developed and emerging markets still meaningful? Because I guess you've got this, if you look at a lot of these, or some of these emerging markets where they're becoming leaders in tech, they've got this kind of growing middle class, and then you kind of put that against developed economies where you've kind of got this instability within political systems, you've got slowing growth and heavy debt. And it almost, it seems like those lines are slightly, I know it's interesting what you're just saying there about, if you look at the MSCI world and it's dominated by the US, and yet kind of the biggest share of GDP is, coming from emerging markets. So is that becoming blurred, those lines, do you think, a little bit?
I think some of the issues or some of the constraints which have held emerging market backs over the last 15 years are beginning to improve and are beginning to change. So when we think about some of the constraints to capital market access, economic development, market size, liquidity, accessibility for foreign investors, we've seen actually a huge amount of progress of key emerging markets over the last 5 to 7 years. And really one of the reasons for this is emerging markets had always been considered this risk on, risk off volatile asset class from an investor's allocation perspective. So when you saw kind of contractionary policies from the Federal Reserve, that could have a very negative impact on investor appetite towards emerging markets, which was a concern that global investors had, but also policymakers in those individual countries also kind of concluded with. So what we've seen over the last 6 years, really driven by India, has been a push towards driving domestic equity participation. So essentially incentivizing Indians in India to buy their own market, which is now translating and permeating across other emerging markets. So that's really been the kind of driver of why we've seen pro-market regulations in India, in China, in South Korea at the moment, in Brazil, in other pockets of Southeast Asia, because they want to essentially improve the fragility that emerging markets had seen and provide it with a much more consistent and steady stream of domestic risk capital. So I think that's a very important point, which is how emerging markets today are very different from where they were 10, 15 years ago. When you think about some of the aspects between developed markets and emerging markets in terms of the competitive advantages, one is obviously innovation. So we've seen in the US, the reason for the US outperformance over the last 10 years has been because of tech dominance. First, you had e-commerce, you had essentially pockets of the Magnet 7 performing very strongly, and we've also had this AI boom over the last 2-3 years. But now we're seeing that in emerging markets, they are being viewed as being comparable and in many cases superior in terms of their tech innovation. When you think about China, we've seen this huge surge in patents, which is now outstripping the growth from a developed market perspective. So just in terms of the market share of patents globally, China has about 10% share, which is up from 1% in 2010. When we think of artificial intelligence, we often think about the US and Silicon Valley, but the building blocks and the foundation of semiconductor chip development is actually built in Taiwan and Korea. And these are companies which are absolutely critical to NVIDIA's growth story. They're absolutely critical to this AI capex story, which drives hyperscaler growth, but also sovereign and private AI capabilities. And these are businesses which essentially are centered in Taiwan and Korea, both on logic and also on memory. So when we think from a global perspective of looking for patents of AI on technological development, we would argue that actually, the lines are pretty blurred, and you have relative valuations in these markets being far more favorable than their US peers. So this is the opportunity, again, which in the context of it being under-owned creates a nice asymmetric opportunity for investors within very similar characteristics and building blocks.
And I'm going to jump a question, actually, and I'll go back to the other questions. But it's interesting because you talk about the US, so I think it's quite a good question to ask. Really, is obviously we've seen this domination of the US in terms of returns, probably for 15 years. Do you think, I mean, obviously, from what you said, I know what the answer is going to, but is there still this case for investing in emerging markets today? Because most people will only look at what's happened in the last 15 years and they won't look forward. So you can almost see, and I'll kind of tie this in with this, another question I had, which was, are trade wars and geopolitical tensions a death knell for emerging markets, or is that just too simplistic? So I guess there's kind of two bits there. Is like, you've seen this dominance, you've talked about obviously the growth and the skills that are coming through from emerging markets, but then you've got all these trade tensions and so forth. So what are your thoughts of the future with those in mind?
So I think it's completely right to have an element of skepticism and cynicism towards emerging market investing because of what's happened over the last 15 years or so. So we call it the lost decade, and really emerging markets other than India have underperformed relative to their US peers. But that's really been driven by good reason. You've obviously had the tech story in the US, which has been very strong over the last 10 years. You've had this period essentially where emerging markets have been through a balance sheet repair process during the 2010s in key large emerging markets. You've had China essentially rebalance its economy and essentially slow down its economy to provide the foundations for probably longer and more consistent growth over the next 10, 15 years. You've had periods where, because of central bank policy, the dollar has been strong, certainly over the last 5, 6 years, which again tends to be a negative impact for key emerging markets. So you've had 5 or 6 reasons which have come together, which have created this dominance of US investing versus their emerging market peers. Now, all investors are looking for the turning point. And we would argue that actually we've seen a number of catalysts in the last 8 months or so, which point to a turning point in that leadership. When we think of the traditional tailwind of a stronger dollar, that's beginning to probably change. So in 2025, we've now seen the weakest performance of the dollar in the last 30, 35 years, just over the last 6 months. And there's expectations for that dollar leadership to potentially wane, which will be balm for key emerging markets. Secondly, in emerging markets, you're now seeing a return on equity and earnings growth story, which is beginning to outstrip their developed market peers. And that's really important because at the end of the day, what we're doing as investors, we're underwriting dollar-denominated cash flows. And we're seeing now emerging markets, having been through this balance sheet repair process, are able to see operating leverage improve, incremental free cash flows compound at high rates of return. The cost of capital in key emerging markets is falling, which creates this profile of faster earnings and return on equity growth versus their developed market peers for the first time in the last 13 years. And that's really important for when we're reassessing the emerging market story. I guess finally, everything, as I said at the beginning, comes down to relative valuation. So it's not the case that emerging markets need to be stronger than the US. It's just in the case of the relative valuation, are things beginning to change? And when we consider the dollar, when we consider the return on equity and earnings story in the context of the relative valuations between the US and emerging markets, which are the widest that we've seen in the last 30, 35 years, this creates a really interesting asymmetric opportunity for investors because it's not necessarily an apple to apples comparison. Rather, it's a part of the market which is at extreme high valuations versus another part of the market which is improving at very low relative valuations. So when we think about potentially the erosion of US exceptionalism, this creates a really interesting reallocation opportunity for investors towards this pocket of the world which is getting stronger. And that's something that I think global investors really do need to consider. And just in terms of the data, this is now beginning to come through. So just when we got the flow data of equity flows into emerging markets, we're now seeing the fastest 6-month data in recent times. And this is really driven by this reallocation away from the US towards international assets, of which emerging markets are very central.
And I mean, it's interesting. Again, it's kind of just talking to people in Cape Verde, and they were. So they have Chinese people coming in, opening up markets where they can buy cheaper goods, and actually they kind of see the Chinese as very aspirational because they've seen how they've gone in a generation from being seen as relatively poor to being relatively wealthy. So they see it as quite aspirational. But where we have these kind of trade wars and this kind of tension, do you think that is a challenge to emerging markets, or are they becoming stronger and being able to deal with these things differently?
So, it's interesting because we're moving from a world which, had aspects of multilateralism, and this was the post-World War II global order, towards multipolarity. So it's less about kind of individual doctrines that are set by the US with perhaps China, and then the world falls in line with that doctrine, towards individual opportunities that the global south are really excited about exploiting and using to their advantage. So the world will get messier, certainly from our perspective, over the next 10 to 15 years. But in terms of key emerging markets, this is exactly what can be beneficial to the development and the economic development that many of them are striving to do. When you think of India, for example, which had traditionally been an importer of capital, it had been an importer of goods and services, there's now a remarkable shift driven by this Make in India project, which is essentially looking to benefit from China plus one. So individual economies not just importing from China, but are looking for a dual source or a triple source resource aspect to their own supply chain. And markets such as Vietnam and India, other pockets of Southeast Asia are beneficiaries of this. So the kind of essentially the complexity that is being created by the end of multilateralism, I think, will create opportunities in certain pockets of industries and verticals and sectors that emerging markets can take advantage of. I think the dollar, which has been a beneficiary of this multilateral story, again, if you do see continued weakness over the next 2 to 3 years, this can be a tremendous boon for key emerging markets as well. From a trade perspective, it's interesting because, when we had the first kind of fallout from what happened on April 2nd, a number of emerging markets saw their kind of markets fall, but the rebound in these emerging markets was far quicker than what we saw in the US. And that goes to show that actually the resilience and the external vulnerability that emerging markets once had is significantly lower than where it was 10 years ago. And this has been driven by an improvement in foreign exchange reserves. It's been improvement in reducing dollar-denominated debt on their balance sheets. It's been through this balance sheet repair process that I mentioned earlier, which means that actually the emerging markets can withstand some of the volatility and the gyrations around trade far better than they were 10 years ago. And this is being seen in terms of what price action has been just in the last few months. The final point I would mention would be, again, technological supremacy. So when we think about the tech story in the US, again, over the last 15 years, originally it was dominated by mobile, then it moved to cloud type businesses, then it moved into e-commerce, and more recently it was really driven by this AI story. But the reliance that the US has on key emerging markets for the building blocks of the AI capex story to work, namely the development of leading edge chips, both on logic and memory side, that's really centered in emerging markets. So again, the importance that they have with the supply chain of where the world is going probably has never been as large as it is today. So we were just out in Asia over May, and one of the most common refrains we heard from companies is tokens is the new oil. And essentially the ability for GPT and compute power generating tokens, which essentially drives AI capability, that really is the critical resource that individual companies and sovereigns have. And again, that's really owned and shaped by the exposure that we have in emerging markets today.
And before we go on to your strategy, I'm going to kind of wrap 3 questions into one, because I think they are important, and I think it may kind of summarize where you've come to. And I think for me, it's been really interesting how you've talked about that kind of development of them. And I guess there's still some things that people think about. One is corruption, and then how do you navigate that? Another side is that, and you've talked a little bit about that, is, are they fragile, or is there potential, or is it, again, I guess it's how you navigate that. And then when we talk about emerging markets, people probably think about China, Brazil, India, but obviously that set is much broader. So I guess around those kind of 3 things about corruption, fragility, and the broad set, it'd be interesting to get your thoughts on that before we kind of go into a little bit about your strategy.
Yeah, so emerging markets are more, they're 24 countries. They're more than India, China, and Brazil. When you think about the top 5 emerging markets, that's China with about 25%, India with about 20%. But then you also have Taiwan and Korea, which contribute roughly 30% together, which again is a very vibrant, IP heavy, technologically leading part of the market, which remains very important from an emerging market context. Beyond those top 5 markets, you have about 19 countries which generate about 21% of the index. And really they encompass quite a wide range of sectors, from energy, materials, financials, consumer, etc. For us, more importantly, trade at significantly deeper valuation discounts. So this long tail of smaller emerging markets provides diversification benefits. It's a potential alpha beyond those top 5 economies, which are typically a lower share in the index simply because of capital market accessibility rather than anything to do with the quality of those businesses. So when we consider emerging markets ex-Asia, which excludes your China and India and other pockets such as Taiwan and Korea, the market itself trades at a forward P of about 9.5 times versus 12 times for the broader index and versus kind of 18 18, 19 times for more premium markets such as India. So this is a really interesting area which we have a significant number of investments. And again, these businesses are really lower in terms of their contribution to the index, not because of any inferiority on their business models or their ability to grow and generate strong cash flows. It's more about some of the issues about weightage from the index perspective. Corruption is a common issue that we have to navigate. It's a common issue in developed markets as well, when you see kind of the number of frauds and cases that sometimes evolve in developed peers. And really for us, we've got ways in which we try and reduce that risk. We focus on businesses which have had long history of creating shareholder returns. We focus quite forensically on accounting quality. When we're looking at earnings quality, we're looking at areas in which cash leakage can materially come through. But crucially, we're looking at businesses which want to see their valuation multiples improve, in which case we work quite closely with these companies on improving their aspects of governance structures. So for us, the perfect type of company isn't necessarily best in class today, but the perfect type of company is the business which has ambitions to be best in class tomorrow, with a definable pathway of how that will be achieved. And governance is an important aspect of that, alongside other issues such as capital allocation and strategic priorities, which we believe can shift to reflect that. So we have seen kind of issues where that's fallen foul. But again, when we think about the oversight, both from policymakers and regulators, alongside what minority investors demand, we've seen quite a palpable improvement in terms of why governance is considered more importantly and how that can drive higher valuation upside for those individual economies. So that really is why we believe actually governance deficiencies are an opportunity, particularly for those types of businesses that are clear and are quite ambitious about seeing its own natural improvement.
And it's interesting. I mean, I think as we kind of move on to talk about your strategy, again, I can kind of, I can almost kind of see where the answers are going on this. And, but I guess one of the things is that, there are lots of emerging markets. I'd say there's a lot. There are a number of emerging market funds out there to choose from. And I guess we'll start with the first kind of area is, why do you favor active management over passive? Because, I mean, surely it would just be easier to just buy the index.
So for us, the journey we went through and the reason why we left our previous employers before founding Mobius and since the GIB Asset Management was because of a frustration as to what active management was evolving into. For us, active management needs to be, from an emerging market context, more than just having a high active share or having a particular style bias. For us, true active management in emerging markets really is about using the tool of engagement with willing and receptive management teams to drive a change in revisions, a change in expectations about what that company can be. So when we think about being active, it's not necessarily just being different from a benchmark, but it's being active with our portfolio companies to change forward characteristics. Now, the key word is change. Change not only implies a company is underestimated and hence potentially undervalued. This is also very difficult to replicate by competing passive, which are by nature backward looking. So for us, the focus, and going back to Michael Mauboussin and expectations investing, is really to think about what's implied in a business today in terms of what the market believes it can achieve, and whether we as active managers working in conjunction with these management teams can drive a revision in those expectations, a revision in the return on equity health of a business, a revision in the cost of capital that the individual business can attract. And crucially, if these revisions come through and we are able to help drive unanticipated change, that essentially implies that the company is underestimated and therefore undervalued. So for us, active management will go through an evolution again over the next 5, 7, 10 years. We believe that the truest form is by working with these businesses to engineer this type of change. So we believe that there is a role of passive, and investors who perhaps haven't looked at emerging markets and are dipping their toes in emerging markets are very right to consider a passive product, because it gives broad exposure towards these businesses which are really shaped by some of the metrics that the benchmark indices look at. But if you are to combine your passive exposure with an active fund, we really wanted to find businesses on which we have a portfolio of companies where the likelihood and the change in revisions of expectations is the highest. And that's really the role that we believe we can have as active investors with these portfolio companies.
I guess it's about, I mean, someone said to me, and I thought it was so true, it's almost like blending styles, isn't it? Is that if you're confident, then you're going to go and go and look for an active manager, because you can do the research and you can look into it. If you're not so sure, you can go purely passive, or you could kind of blend styles where you've got, active with management, with that. And I guess it's, is it worth paying for it? Well, it depends on the strategy. And I guess that's what I want to get into the heart of your strategy, is that you've talked about change. And it would be really interesting to hear more about what does active engagement mean in practice, because I guess that's probably at the heart of what you do.
Yeah, so we're looking at a high conviction portfolio, so a concentrated portfolio, typically of 30 ideas. And each of the companies are quality companies that are undervalued. Now, that might sound like an oxymoron, but they're quality companies undervalued not because of deficiencies in their core fundamentals, but because of deficiencies in areas which are fixable. So deficiencies in areas such as capital allocation, strategic and operational improvements, disclosure, how they think about investor relations, on governance, in their approach to sustainability, all of these aspects which we believe that the company can see a revision in their expectations. And what we're doing as active investors is working with these portfolio companies, firstly to identify these pockets and areas of hidden value, and then working with them in a constructive way to engineer a change to drive these revisions, which therefore mean that the businesses are underestimated and hence undervalued. So really the framework of this engagement approach, or this active engagement approach, we call PACE, which stands for our process for active corporate engagement. And really it focuses on two aspects of the business. The first is all areas to improve the compounding power. What can we suggest to our portfolio companies to help them move to a higher return on equity pathway? Is it through aspects on their reinvestment strategy? Is it on potentially working capital unlock? How do we think about potentially accretive M&A? Or if it's a company that doesn't require cash to grow, how do we think about capital returns and balance sheet optimization? So we will provide our portfolio companies 3 or 4 ideas, which essentially move these businesses, we believe, to a higher pathway of compounding power and return on equity. The second aspect of PACE is really to focus on what we can do to help drive down the market implied cost of capital. So what can we suggest to these businesses to help improve investor perception? So here, this is stuff like governance enhancements. How do we potentially split the chairman and CEO? How do we move these family-owned and family-run companies to family-owned and professionally run businesses? How do we think about improving investor relations, disclosure, which is a friction point for a number of institutional investors? How do we think about sustainability as being a driver of returns? And can they, again, attract a larger bouquet of institutional investors globally? So all these aspects focus on either compounding power and cost of capital. And at the end of the day, that is your valuation equation. Your numerator, return on capital, your denominator, your discount rate or cost of capital. And if we're able to affect either or both of them, that's how we believe we can say to these businesses that can generate value creation for those companies. Now, what we're focusing on are businesses which are receptive to this change. If you are a state-owned bank, if you are essentially owned by the government, if you potentially are a multinational corporation, the ability to affect this change is lower, but that's okay. What we're really looking for is a subset of companies on which the alignment with minority investors is high, which means that the direction of travel towards this value creation roadmap is significantly easier.
A couple of things that kind of spring to mind as you're talking about that is there's this kind of belief that if you hold around 30 companies, and therefore you're concentrated, it creates additional risks. So it's seen as high risk. How do you view that? Because obviously that's what you look at, is you look at a small concentration of companies. And so somebody might be looking at that and go, well, no, that's way too risky. So how do you think about that side of things?
So, I think there's a lot of literature which has been written, which talks about kind of 22, 23 companies is the level in which you can essentially drive down systematic risk and expose idiosyncratic risk. And that's really when you can get the benefits of diversification. So that's something which we would concur with. The way in which we manage it ourselves is by having exposure across all emerging markets. We're not a fund which has pockets where we're double, treble weight in certain economies or zero weight in other geographic markets. Really, we want to give broad exposure to all emerging markets, but the returns we're generating is driven by stock selection. So individual companies that we own in China or Korea or Taiwan, they outperform their own local market. So the first point is we're not taking bets from an asset allocation perspective on what China policy will be tomorrow, or what Indian the political outcomes will be, or what will happen from a Brazilian inflation perspective. Rather, it's much more about the granularity of the individual companies in those markets performing better than what the wider market does, which drives the stock selection composition. And that helps us in terms of how we manage the volatility and the diversification of the product, because it is businesses that exist across the entire global emerging market perspective. The second aspect is from a style perspective. We try and reduce style risk by having pockets of the portfolio which are more quality growth and other areas of about 30-40% which are more quality value. And typically these are businesses which both require, we believe, some improvement in perception either on their companies or how they can improve their return on equity profile. And that informs the engagement action plan that we have for each of those companies. But it's not a fund which has 100% of its allocation towards one particular style, which means that if essentially some of the macro tea leaves change, then that style can be very much out of favor. And again, that protects us from that diversification perspective. But for us, it's really beyond that 24 companies that we believe can essentially run a portfolio which has the benefits of diversification, but also crucially, we're betting on businesses which we have high conviction, and that's what having a concentrated approach affords us.
And the other thing that you've talked about is sustainability. And there's a debate around that. Is it just ESG screening? So just looking at environmental, social governance and kind of just ticking boxes, or is it something that's much more integrated?
Yeah, it's definitely not the former. For us, sustainability as a source of returns has always been very bespoke to the individual company to identify ways in which aspects of sustainability can reinforce and improve the competitive advantage of that individual company. So when we actually provide our engagement action plans, our areas of value creation for our portfolio companies, we do this typically, or we always do this actually, through a bespoke presentation that we give to the management team or we give to the board of directors. And for us, sustainability is a part of that, which typically looks to improve either the revenue opportunity that the companies can command or reduce the risk associated to that particular company. So really for us, it's very much tailored to the individual company about what matters most for driving an improvement in the competitive advantage. Typically, it'll work by initially introducing a materiality matrix for the business about all the various NPV positive projects that can be done and linking that to the maximum sustainability improvement that it can generate. And we then look to essentially push that or create the ownership with the individual company through creating an oversight group within the board or an individual board member responsible for those KPIs that constitute success from that sustainability matrix perspective. And finally, we then look to reinforce it in terms of compensation. So about 30% of variable compensation, again, for key management linked to those KPIs. So for us, it's never about a scorecard. It's never about a one size fits all. It's very much tailored towards the individual company about, again, how they're able to improve their standing versus competitors, how they're able to improve their standing with their own customers, and crucially, how they're able to reduce the risk associated to their cash flows, which can therefore improve both the compounding power, the cost of capital, which can argue a higher valuation multiple. And what we've seen, certainly across emerging markets in the last 3 or 4 years, is a dramatic improvement in receptiveness on these types of action points. Firstly, on governance, and we've seen that in Korea at the moment with the Value Up program, where minority investors matter much more, again, to accelerate this domestic equity ownership that key emerging markets want. And secondly, just because they understand that from their own customer perspective, environmental and sustainability and social norms matter much more, which again is why they want to improve their standing with their customers. So for us, it's very much about bespoke approach to the individual companies focused on the materiality of improving their standing in areas that can matter most.
And kind of a couple more questions around your strategy. One I think would be quite interesting is perhaps if you could just bring this to life with perhaps a company you've invested in either currently or in the past, and how that process has added value.
Yeah, sure. So, there's a list of companies we can go through. I think, one of the ones we're working on at the moment is a business in Korea, a company called APR Core. They essentially do cosmetics for skincare, which is a increasingly important kind of aspect of consumer demand, both in the US and other developed markets and other actually emerging markets. And they also provide, or they're a market leader in home beauty energy-based devices. So when you apply your skincare to your skin, you also complement it with energy-based device, which helps the absorption of those cosmetics and improves the collagen regeneration, which makes you look younger and more beautiful. So that's really the opportunity that this company provide. They are a business based in Korea. They have about 25% market share in the home beauty devices. The addressable market that they serve is about $350 billion. But really, the real growth story has been these energy-based devices, which you can use at home rather than having to go to a clinic, which is more expensive, it's more time-consuming, and arguably doesn't have superior clinical outcomes. So it's a company which we invested last year in. It was a few $billion market cap. And really for us, the core competencies were driven by its IP, driven by the technological advantage it had in terms of those devices, was driven really by essentially the distribution strength that they were looking to shape. But it was a business that we believed, relative to the earnings stream it could achieve, the valuation of that company was about 13, 14 times PE, despite our essentially ability to forecast the company seeing an earnings power of about 25 to 30%. And really the reason for this valuation discount was pretty weak investor perception. It was a recent IPO and it had some issues with capital allocation, and investors weren't necessarily completely on par and comfortable with governance structures. We believe that there were parts of their strategic mission and roadmap which we thought could be improved. And also there are aspects from a margin perspective which could easily be improved, again, to improve how investors were perceiving this business. So we started to work with the company towards the end of last year. We presented them with 2 presentations, which really articulated not why the company was something which we were concerned about, but rather we believed that the power of the business was something much greater than what the market was giving them credit for. And really the value creation focused on improving their distribution channel, on how they could essentially articulate their technological vision in a far better way, aspects on capital allocation, which again, we believe could be improved through how they approach buybacks, dividends, but also reinvesting in their core business. And crucially, how they could potentially look into move into the male market opportunity, which was still very small. Over the last 3 or 4 months, we've seen some of those action points come through, and the performance of the stock has been strong, really driven by a falling cost of capital as investors have been able to see that actually the perception of this company can be improved, and then that's really been reflected by what we've seen. So really for us, this kind of brings to light a business where the company itself, we believed, had strong franchise value, but the reason for the valuation deficiency were in areas which were fixable. And that's really what that bespoke engagement plan focused on to drive a change in.
So just wrapping up this bit, and then we've got some final reflections. In 60 seconds, well, it doesn't have to be 60 seconds, but what makes kind of, if you brought this all apart, what would you say makes your strategy stand out from your peers and perhaps passive options?
So for us, the way in which we think our portfolio is different is because we think it's the truest form of what active management must mean. Core active management should be more than, again, having a style bias or just a particular deviation from benchmarks. For us, active management must drive a change in company characteristics, which therefore mean a company is underestimated. And for us, share prices move because of unanticipated change, a revision in expectations, either in terms of compounding power or the discount rate attached to those business. And for us, what we do is essentially try and catalyze unanticipated change to create higher valuation upside. And for us, this is most importantly, done in a concentrated portfolio. Each of our individual ideas is backed by an investment thesis predicated by the potential of change, which is what our active engagement work centers on. At the same time, we're very aware that we want to give investors exposure to all emerging markets. This isn't a fund for which it's concentrated in certain pockets, but really it's focused on finding 30 businesses across the 3,000 companies we can look at, which have the most material chances of seeing a revision in expectation, which fundamentally causes share prices to go higher. So for us, it's this private equity approach to public markets, which is really what core active investing will evolve into from an emerging market stand.
That's really interesting, and I thank you for that. So I've got kind of final reflections, which are kind of, I guess, are more personal to you a little bit, but also a little bit about GIB. So going for the big picture, do you personally believe in sustainability as a core investing principle, and why does it matter to you?
Yeah, I think sustainability has always been an important part of our investing framework. For us, material aspects of sustainability improvement is what we focus on and is the most crucial aspects of it. So if it is aspects to improve governance, to drive essentially a lower cost of capital, that for us is material, which is interesting to see an improvement in those aspects. If it is environmental aspects, which a company is focusing on, again, to improve the revenue capability or reduce cost or reduce risk associated to their own cash flows, again, that's interesting for us. So for our perspective, it's always been about material areas that sustainability can bring, just as we look at material aspects of strategic improvements or material aspects of operational augmentation or material aspects of how a business is able to affect and improve its own investor relations, as an example. So sustainability isn't the only aspect of what we do, but it's a key part of the engagement action plans we have to help improve how a company is positioned and how it's perceived by investors.
Then, in terms of your commitment to GIB, can you just can you just give us an idea? That's a really hard question, isn't it? So the question is, how committed are you to GIB and the long-term vision behind this fund?
Yeah, so for us, GIB offers us a huge advantage in terms of the scale, the infrastructure scale that they bring. So you have, in essence, almost a multi-boutique approach where they're able to offer very strong infrastructure support in terms of business development and compliance and legal and middle office and back office. And it allows us to kind of essentially focus on the investing, which is absolutely central to what we do. They have long ambitions to scale active management. That's something that's very central to the strategic vision of the group as a whole. And again, this is something that very much aligns with what we're looking for. It's, no secret that active management and boutiques in particular are under stress and under threat over the last 3 or 4 years. But combining our philosophy and process and our approach to what we believe true active management to be, alongside the balance sheet and the longevity of their investment horizon, I think that's a very nice kind of partnership that we have with GIB, which for us is something that's very attractive.
And then kind of the last bit is a little bit of another 60-second pitch. Why should investors consider emerging markets over the next decade?
Well, I think, emerging markets are very much early in their kind of life cycle. Certainly from an investment perspective, emerging markets contribute half of the global economy. They contribute the bulk of global growth. They're looking to add more workers over the next decade than anywhere else, and yet they remain underowned at just 6 to 8% of global indices. The reason for the underrepresentation in global indices is because of issues which are being solved. So things such as market accessibility, governance structures, liquidity of those markets will only improve in the next 3 to 5 years, which will mean the contribution in benchmarks of emerging markets will likely expand. And so when you think about the contribution from an output perspective, that's already been reflected, that these are the engines of global growth for the next 10, 15, 20 years. But the engine from an investment perspective, we think will now begin to be mirrored by what we're seeing on the ground. So this creates an opportunity for investors who have traditionally been centered and concentrated in the US to diversify their own investment allocations and the time is right given the relative valuations that we see at the widest level seen in a generation.
Thank you, Kunal, for joining us today. And I've written down so much stuff, and there's and I think just kind of you opening up and being honest, and I've kind of picked up, when we talked about, I could pick up on the corruption side, and I think it's so true. It's like we focus quite heavily on that, but you get it in any market. And I think understanding how, actually investing in 30 companies doesn't have to be high risk. It's how you engage. And that's been really interesting. And also talking about that kind of broad sort of set of opportunities that you can look at. I think all of that has been really interesting. I think your answers have been, really thoughtful, and it's kind of given a kind of refreshing perspective in what I think is an area that is quite misunderstood. And I also think, with everyone so focused on the US, it's often a little bit late when people suddenly realize, oh, we didn't see that coming. So I really do appreciate your time for that. To anyone listening to this, I'm here to kind of spark conversations, think about challenging the normal assumptions. So please subscribe, share, leave a review. I will put details of the books that have been mentioned. I'll also put a link to GIB as well. And until next time, please stay wise, stay curious. Thank you again. Thank you so much.
Thank you very much.
All right. Thank you.